Hey guys, what's up? I'm Erin and welcome back to the channel. How much can I spend in retirement? It's a question we all ask, and the answer we tend to get is 4%. But the problem is, that's pretty much an oversimplification. It's based on a very traditional retirement, a specific portfolio allocation, and one that lasts 30 years. What if you want to retire early or later? What if a retirement lasts 40 years or just 10? The truth is, your withdrawal strategy needs to adjust based on your timeline, your goals, and your income sources like Social Security. So let's break down research-backed withdrawal rates based on different retirement durations. And let's look at it from different income levels, maybe a $40,000 income level or a $100,000 income level. And importantly, based on popular request, let's break it down if you're retiring coupled up or retiring solo. So with that said, let's dive in. Let's start with a 40-year retirement. This is a longer retirement horizon. Maybe you're retiring at 50 or 55, and because it's an extended retirement horizon, you're gonna need to have more caution. You need to be prepared for more market cycles, inflation changes, and just unexpected expenses. At this point, we might look at a withdrawal rate range from 3 to 3.6%. Here's where these numbers come from. It comes from Morningstar's 2023 research on safe rate of withdrawals. They came to the conclusion that with a balanced portfolio and with a 90% chance of success, you could use a 3.3 rate of withdrawal for a 40-year retirement. Financial planner Michael Kitces suggests the 3 to 3.25% range is safer for early retirees. More aggressive strategies like a 3.6% rate of withdrawal for this retirement horizon really might only be viable if you have a high equity exposure and flexibility in your spending. If we needed $40,000 as an annual income from investments, depending on the withdrawal rate you wanted to use, you would need a portfolio of roughly $1.1 to $1.3 million. The more aggressive the withdrawal rate that you're willing to use, the lower the investment total you would need to hit this income target. But keep in mind that that does introduce more risk to the portfolio. Let's move to a 30-year retirement, which is the classic scenario the original 4% rule was built around. Think of someone retiring at, say, 65 and living until the age of 95. And because this is a shorter time horizon in retirement than an early retirement, you can afford to have a higher rate of withdrawal, and it doesn't put as much pressure on your portfolio long term. In this case, a reasonable withdrawal rate range might fall between 3.7% and 4.8%. Here's where those numbers come from. First of all, Bill Bengen's original research, the foundation of the 4% rule. He based his entire research on 30-year retirement time horizons. But as time went on, he redid his analysis and added more research and included more asset classes and had more timelines looking at market conditions. And ultimately, he revised his recommendation and said that we could push the upward bound of the 4% rule to maybe 4.5% or 4.8%, so retirees could spend more in a safe manner. So if your income goal is $40,000 per year and you're withdrawing from your portfolio over a 30-year retirement, here's roughly what you would need saved. About $833,000 all the way up to, say, $1 million if you have a more conservative withdrawal. And noticeably, this is a portfolio that is much smaller than what we saw when we had the earlier retirement, and for good reason, because at this point or in the near future, Social Security would kick in. And that in and of itself allows you to alleviate a lot of the pressure on your investment portfolio and allows you to stretch your investment portfolio out for longer. And remember, this is truly what the original 4% rule was built on, this traditional 30-year retirement. Now let's talk about a 20-year retirement. This might apply if you retire later. Say you retire at 70, or you simply delay tapping into your investment accounts. Well, at this point, your timeline that you need to fund in retirement is shorter. This allows you to, again, up your withdrawal rate and give you more flexibility. For this kind of retirement, a reasonable withdrawal range might fall somewhere between 4.5% and 6%. Here's where those numbers come from. Both Wade Pfau and Michael Kitces suggest that 4.5% range to 5.5% range. say that these can be a solid target for a 20-year retirement duration. Also, major institutions like Vanguard and Fidelity say that these similar numbers can support a shorter retirement. So if your goal is to withdraw $40,000 a year, here's roughly how much you'd need saved up. With a more aggressive withdrawal rate, you'd need around $667,000 in investments. And for a more conservative withdrawal, you'd need closer to $889,000. That's nearly half of what you would need if you were comparing it to the investment account needed to fund a 40-year retirement. This goes to show that the time you need your investments to last, the duration of your retirement, has a huge impact on the size of your portfolio. And I get that that's common sense. So if you're not retiring until 70, or for some reason you're not drawing on your investments until later in life, you don't need as robust of a portfolio. You have a shorter retirement that you need to fund. Finally, let's look at a 10-year retirement. This is a very short drawdown period. Maybe in this situation, you're just using your investments to bridge the gap until you get to Social Security, at which point maybe Social Security covers all of your expenses. So your investments are pretty different at this point. You don't really need a traditional retirement plan. You just have a more fixed withdrawal because you have such an abbreviated timeline. In this case, the safe rate of withdrawal range is higher, typically somewhere between 6 to maybe even 7.5%. So where does that range come from? Well, this actually comes from actuarial tables saying that you could go to 6, maybe even up to 8 or 10% when longevity risk is off the table for a portfolio. At this point, it's less about preserving your portfolio against market volatility and more about knowing that you have the cash on hand and ready to spend for the decade you need it. If your goal is to withdraw $40,000 a year, here's what you might need. Anywhere from $533,000 to, say, $667,000, depending on what withdrawal rate you are comfortable with. If your investment portfolio only needs to carry you for 10 years, this adds a lot of flexibility and your portfolio can be dramatically smaller. This can be great for a phased retirement or for a bridge period or for early partial drawdowns. So those are your withdrawal rate ranges and savings targets depending on how long you would expect retirement to last at this income level. The longer your money needs to last, the more conservative you'll need to be. The good news is there's no one-size-fits-all number. What you have to do is find a number that works for your strategy and your lifestyle. Now, here's a really important point that catches a lot of early retirees off guard. An income of $40,000 at 50 is not the same as an income of $40,000 at the age of 65. At 65, you likely have backup, you likely have Social Security, you likely have Medicare, and quite frankly, you have a shorter time horizon to fund. But if you retire at the age of 50, a lot of times you're doing this solo. You don't have anything else to fall back on. There's no Social Security yet, there's no Medicare, you have to fund your own health insurance, and you have a longer time horizon. This puts a lot more pressure on your portfolio. This creates two phases in early retirement. That bridge phase, your early years, which are self-funded, and then the support phase, where Social Security kicks in and helps to reduce the draw on your investments. Let's say you retire at the age of 50 with the target income goal of $40,000 a year. Well, in this case, you might need about $700,000 alone in investments to bridge the gap until Social Security kicks in at the age of 67. Let's say once Social Security kicks in, you're getting $24,000 a year. Here, your portfolio only needs to cover the remaining $16,000 a year, meaning that you'd only need another $350,000 or so for the back half. Total, this would be a little bit over $1 million. Now let's compare that to retiring at 65 and assuming Social Security has already been claimed. How does that change things? Well, at this point, you may only need $400,000 to $600,000 in investments to hit this same income target. The bottom line is that retiring early means you have a longer time horizon to cover, and it means that you have to do a lot of heavy lifting yourself in the beginning. And understanding that and how that changes retirement math is a key to having a successful investment portfolio that covers all your years of retirement. So if you're planning to retire early, how do you actually make it work? especially if you have a big income gap to cover before Social Security kicks in. Well, here are some strategies that can help. First, consider using a Roth conversion ladder. This allows you to tap into retirement funds prior to that magical age of 59 and a half without having to face any early withdrawal penalties. It does take some planning to get this in place, but it can be invaluable and give you access to your funds when you need it the most. Next, diversify your tax buckets. Don't rely solely on a 401k. You want a mix of taxable, Roth, and traditional brokerage accounts. This can really give you unlimited flexibility and really help you to reduce your tax bill, especially in those early retirement years. You might also consider part-time work or a small side hustle. Even a little bit of income can dramatically reduce the pressure on your portfolio in those critical bridge years. And if possible, delay Social Security. The longer you wait, the bigger your monthly check, and that means you don't have to draw as much from your investments later on. Finally, think about using the bucket strategy for your portfolio. This approach really segments your savings and your investments into 3 time-based categories. Bucket 1 holds cash and short-term bonds to cover the next few years. Bucket 2 is filled with intermediate bonds and maybe dividend-paying stocks for stability in the midterm. And Bucket 3 stays invested in stocks to fuel growth for your later years. I do have full videos dedicated to the 3-bucket strategy that I will link above and down below if you're interested in checking them out. But having your money arranged like this not only gives you a sense of structure, but it also gives you a sense of peace when there's a lot of market volatility, because no matter what, you know that your short-term spending is covered. Now that we've talked about withdrawal rates and time horizons, let's bring it all together. Now let's build a portfolio where someone wants $100,000 as an income throughout the course of their entire retirement. Let's look at how that impacts the portfolio when we factor once Social Security kicks in. And importantly, because this is a popular request, let's look at what this would look like for a married couple or a set of people who are coupled up versus someone who is retiring solo. Let's start with the 40-year retirement, early retirees. For the first 10 years, you are fully self-funding your lifestyle with no Social Security or Medicare to help. And because your money needs to last for decades, the portfolio requirements here are steep. For a single retiree, the conservative end of the range is just over $3.5 million. For a married couple, it's closer to $2.8 million. Here you can really see how having 2 Social Security checks coming in really eases the investments on your portfolio. Now let's move to a 30-year retirement time horizon, this more traditional retirement time horizon, and we'll assume that Social Security is active throughout the entire course of retirement. You'll see that the saving need drops quite a bit. A single retiree would now need between $1.6 and $2 million, depending on how conservative they want to be. A couple would need anywhere in the range of $1.1 to $1.5 million. That's a major shift, and again, it's largely thanks to the steady income that Social Security provides. For a 20-year retirement, the savings target comes down even further. A single retiree would need anywhere from $1.3 to $1.7 million. A couple, they would need just under $1 million to $1.2 million. And finally, with a 10-year retirement, the numbers become even more manageable. A single retiree might need only around $1 million. A couple can probably get by with as little as $725,000 at the more aggressive end of the spectrum. All of this shows that Social Security, or really any other form of guaranteed income stream, really alleviates the pressure and how much you need to have built up in investments. The longer you can defer your withdrawals, the shorter the retirement time horizon, the more support you have, maybe in the form of a partner also receiving Social Security. All of these have a major impact on the total portfolio needed. At the end of the day, there is no perfect one-size-fits-all withdrawal rate. It depends on a lot of different moving parts. How long do you need your investments to last? When do you expect Social Security to kick in? Do you have a partner, or are you retiring solo? What does your investment portfolio look like? So wherever you are on the retirement timeline, 10 years out or ready to go now, just know there's a way to make it work. It's all about planning with purpose, building flexibility into your strategy, and staying aligned with what you value most. With the right strategy and clear expectations, you can absolutely build the portfolio that supports the lifestyle you want without the fear of running out of money. What is your target time horizon for retirement? When do you plan on retiring, and how long do you want that retirement to last? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. By 50-year time horizon. No, I didn't do 50, I did 40. I should probably stick to what I actually cover in the video. Okay, I just had like a dramatic thought. I'm like, am I not centered? And I didn't even know. Okay, well, we're like 2/3 of the way through the video. It'd be too late to fix. I think I'm good. Michael Kitces. I'm not sure if that's how you pronounce his name. I do read his stuff, but I read it. Let me Google it. How do I say this man's name? How do we say it? Somebody tell me.
2 hours later.
Kitces. How do you say it?
The next day.
Kitces? I'm going with Kitces.
One debt to society later.
Okay, I'll ask Google. I already did, but like it's not there.
3 days later.
Michael, if by chance you watch this, can you tell me how to pronounce your last name? I want to get it right. I just don't know how to do that.